handles a trending market and make accurate trading decisions. So if you had to take a guess of what trend the Euro New Zealand was in, which is the chart that is in front of you, what would you say? Uptrend, downtrend, or consolidation? Hopefully you were able to say an uptrend. And simply put, an uptrend is nothing more than when a candlestick chart is consistently making new highs and then higher lows, followed by new higher highs, new higher lows, new higher highs, new higher lows, new higher highs, new higher lows, and so forth. This higher high and higher low situation is what is referred to as a trending market, and this particular situation would be an uptrend. Now, the reason we utilize a trending market is because it gives us more accuracy on our trades. You've probably heard follow the trend before, and most beginners will gravitate towards trend trading for good reason. Again, it adds accuracy to your trades. It can make for better reward to risk setups. And all in all, it's much easier to ride a trend that's already there than to pick the very top or the very bottom of a market trying to trade reversals. So it's a good thing to trade with the trend. With this market being in an uptrend, what direction would you like to trade this market? To the upside, right? You'd want to be buying while the market is in an uptrend. But here's the problem with trend identification that I see all the time, and that is just not really understanding or having a set in stone, objective, defined way to identify trend. A lot of traders can easily identify this, right? That's an easy trend to see. But what if price is acting like price normally does and it looks more like this? We have our high to low, a new high, but then price does this, and then finally goes up and then goes up again. At this point, doesn't it get a little bit harder to identify trend? So with that being the case, I want to give you an objective way to identify trend right now. What we have in a trending market are impulsive moves. That is the big moves that break into new highs. Right here is our impulsive move. I'll label those with an I. These are the impulsive moves. After an impulsive move, the market takes a breather. We call that our pullbacks. These are our pullbacks in price. This would be a pullback, followed by our next impulsive move that breaks a high right here, impulsive move, and again, pullback right here. So the objective way that we're going to be identifying trend is the lowest low of the pullback cannot be broken for us to stay in an uptrend. So once we have this move that breaks and closes above our previous high, we call that our what? Impulsive move. Once we have that impulsive move breaking into new higher highs, which is what we're looking for in an uptrend, this market is still considered in an uptrend until we break or close below the lowest low of the previous pullback. So when we get a break above this high right here, when this market breaks above this high with the new impulsive move making a new higher high, then this market is still considered to be in an uptrend until or unless the market breaks and closes below what? The lowest low of the pullback, which would be where I just put this line. This is the lowest low of that pullback. So as long as the market stays above that low, then we're still considered to be in an uptrend and we still want to look for buying opportunities. At this point right here, we have had what? Another impulsive move. This move is our impulsive move because it broke above the previous higher high. At this point, what level cannot be broken for us to continue this uptrend? We cannot see the low of our pullback broken. Where's the low? That's the lowest point price got to in this pullback. As long as the market stays above that level and continues making higher lows and higher highs, then we're still in an uptrend. What we do not want to see is the market come down and break below that previous low of the previous pullback. I know that might sound complicated. We'll do it on a real chart to help clear things up. Also, if it sounded complicated, just go back and rewatch this portion of the video. This is how I objectively identify whether the market is trending up or down. Is going to be the opposite. We'll look at a downtrend as well. But the reason we have to have this information is because we want to be trading alongside the trend of any given market. If this market's in an uptrend like this, do I need to be trying to sell and go short and go against the trend? No, because the likely scenario is that we're going to continue into this trend. We're going to continue breaking into new highs. And just to show you that, let's click play and see what happens. At this point right now, looking at the chart, what do you expect to happen? What do we have? We have our low, just as we were just drawing it out, to a high, a higher low, a higher high. Here's our higher low right here, our higher high, our higher low, our higher high, and our higher low. We have now done what? Created an impulsive move. What do we expect after the impulsive move? We expect a pullback, but what cannot happen? This pullback after our impulsive move cannot break and close below the low of our previous pullback. This is the low of our previous pullback. So if this market does this, then we're expecting what? A possible reversal. We're expecting this market to possibly head lower. But as long as we stay above this previous pullback, we're still considering this market in an uptrend, still looking for buying opportunities. Let's see what this market does. Boom, just like that, we break into new structure highs, continuing this uptrend here on the Euro New Zealand. So that's how I identify uptrends. Let's now switch the script, flip the coin if you will, and take a look at downtrends and how to identify those in order to make more accurate trading decisions. So if for a uptrend we are looking for higher lows and higher highs, what do you think we're looking for with a downtrend? It's the complete opposite, right? We're looking for a starting point here, then we're looking for lows, followed by a lower high, followed by a lower low, followed by a lower high, followed by a lower low, followed by a lower high, so on and so forth. And with this being the case, just like with the other example, I'll give you an example on the whiteboard here. If we're heading lower, it's really easy to identify this as a downtrend. This chart, extremely easy. What about when price does what price normally does and we get something like this? And then the market goes like this and gets higher and consolidates and then finally breaks below this low. Well, now, since we just went over this, you know that this is still a downtrend unless what happens? Just like an uptrend, we have our impulsive moves here, followed by pullbacks. What we do not want to see is the market break and close above the high of the previous pullback in a downtrend. If that happens, then we're considering that a possible reversal. But as long as that doesn't happen, then we are still in a downtrend. And what kind of trading opportunities are we looking for if this market's heading down? We're looking for selling opportunities as long as the market continues to head in the downward direction. So that is my objective way of identifying trend. And at this point, you have a lot of knowledge you've gained throughout this video. You now understand candlestick charts. You understand how to identify a trending market, whether that be up or down. So if you've already gained value, why not go ahead and smash that like button for me? And what we're going to do now is talk about how to find high probability areas of value using structure, support, and resistance. See you there. Support and resistance are simply areas in the market that price is likely to react from. Support is an area in the market that price is likely to have a bounce up from or be supported by, whereas resistance is an area in the market where the price of an asset or currency pair or crypto or stock is likely to fall or drop down from. These areas are based on historic price and based on other areas of support and resistance we can see in historic data. And those are based on the decisions of all other market participants. We're not going to dive into the psychology of support and resistance in this beginner video, but these areas of support and resistance are useful for three main reasons. You can use them to spot possible reversals. You can use them as entry points on trend continuation trades, and you can use them to help you determine your stops and targets. So what we're going to do right now is go over a couple of those. As I said earlier, most beginners are going to gravitate towards trend continuation trading. So what I'm going to do is show you how to use these areas of support and resistance to make better trading decisions while in a trending market. And I'm going to go over how to use them to help you set your stops and targets. So let's go ahead and dive into some charts and talk about support and resistance and how they can help us make better trading decisions. Using support and resistance as entry points in a trending market is very simple if we build on what we already know from the previous lesson about trend. If we were to draw out a trending market, it would look something like this. Low to a high, pullback, break above, a little bit of consolidation, not crossing that previous pullback low though. So what are we still in? An uptrend, right? Continuing, then pulling back, continuing up, pulling back, and continuing higher. In an uptrend, the likely scenario, if we're going to continue in this uptrend, and one of the best ways to look for possible support and resistance trades is to look at the previous level of resistance that was broken to become support. This is how we use support and resistance for entry points in a trend continuation model and in a trending market, is by using that previous level of resistance as possible support. Let's do a bearish example. In a bearish trend, the trend would look something like this, right? As we go further and further, what we're looking for in a bearish trend is for the market to get back up to that previous level of structure support that now we expect to become resistance. So this is called a break and retest strategy. And what we're looking for with this strategy, again, is the market to break below a previous level of support like we have right here, come back to that level, and provide a trading opportunity. We're going to talk about how we enter trades later on in the video. But what you need to know right now is using structure support and resistance for entry levels in a trend continuation model and in a trending market goes like that. And what we're going to do now is take a look at this on live chart data. Here we are on that same Euro New Zealand chart. What did we just discuss? Well, we want to see the trend start. So we have our low to high, higher low, followed by our higher high. At this point, the reason this is our higher high is because this is where the market made a new high compared to its previous high and closed above the previous level of resistance. With that being the case, the previous level of resistance is likely to become support for a trend continuation market, for a trend continuation trade. If we continue looking here, we have a push up, a pullback, a push up to a new high. This pullback, where does this pullback come to? If I was to draw this box out right here at our previous level of structure, resistance, and make it a little easier to see for you, what do you notice? At this point, with this trend continuation in mind, the market made a new high with our impulsive move. Comes down to our pullback. Where does our pullback come to? Our pullback comes right into the previous high that was broken. This is resistance turned into support, and this is how we use support and resistance to find entry points in trend continuation. Let's take a look at a bearish example of this now. Here we are on that same Euro Aussie chart we looked at for the trending model we were discussing earlier in the video. In this case, we have our high, down to our low, up to our high. Once we break below this low right here, what are we looking for? In a bearish trend, after we break that low, we would be looking for a pullback, and let me delete these lines to make it easier to see, into that low, just as we have right here, and a continuation of the trend afterwards. As you can see, this market pulls back right into the previous area of support. It does become resistance, and this market continues pushing down. This happens over and over again and looks to be happening right now on live chart data here on the Euro Aussie. Let's draw that out so you have a complete comprehension of how to use support and resistance to find entry points in trending markets. We have our high to our lower high. What happens? We break below what? Our previous low. If we put a box around that previous low, what has price now done? Price has now came back into that previous support level that now is what? It's a break and retest strategy. So if it was support, it's now going to be resistance. So at this point, once we get to that level, we can start looking for entry reasons. Again, we're going to talk about ways to enter the market in these types of situations a little bit later on in the video. But for now, it's just important for you to understand and comprehend that we're looking for breaks and retests of support and resistance levels in trending markets, whether we're trending up or down. That shouldn't have been too hard to comprehend, but if you had any trouble, rewind the video and watch that section again. Now let's talk about how to use these levels for possible targets. Let's go back to a bullish example. So for a bullish example of this, let's say that you got a entry in this area on a lower time frame. Let's say you dropped down and you saw like a double bottom or something in this area. If that's the case, then the way we could use support and resistance for possible targets is this level of support, this box that we drew. We definitely want our stop loss below that level. So with that being the case, we would make sure that our stop is below that level, keeping us safe. In terms of what we can expect out of targets, the way we use this to prepare to take those targets is if we're expecting trend continuation. And before I continue, do you see how everything's coming together? We learned about trend in the last section. If your pullback has not broken below the low of the previous pullback, then what's the likely scenario? That we break above these highs, right? Into new highs and continue in this uptrend. With that being the case, what if you said, well, the way I'm going to take targets on this trade is by looking at the previous high and taking my targets there, because the likely scenario is that this market continues higher. So then you would place your targets based on this resistance level right here. And that is how you use trend and structure in order to give yourself good reward to risk ratios and accurate trading opportunities. In this case, would have been about a 3.6 reward to risk ratio on this trade. My camera literally just died on me, but I have an extra camera, so no worries. Let's wrap it up with a recap. For a trending market to the upside, what we are looking for is a level of resistance to break. And then we're looking for the pullback after the break of that level of resistance to come back to that level of resistance. We're then looking for that level to become support in an uptrend and in a trending market. For a downtrend, we are looking for quite the opposite. We're looking for a level of support to break, and then the market to have a pullback that comes back to that level of support. We're looking for that level of support to become the likely area of resistance for the continuation of that downtrend. In terms of stops and targets, we're using these levels to make sure our stop loss is beyond that level of support that we point out or that level of resistance we point out. And we want to look left and make sure our targets are not close to a level of resistance for a buy trade, or not past a level of major resistance, because that level of major resistance may push the market down. We want to make sure we take targets or at least roll stops to break even before the market gets pushed down by that level of resistance. The opposite is true in a downtrend with a level of support. If you're selling, you want the market to go lower. You don't want to be beyond a level of support. So that wraps up the support and resistance lesson. Next up, we're going to talk all about indicators and how they can help you make better trading decisions. Let's do that right now. Before we get started, I need you to make your chart look exactly like this. Just joking, but trading indicators are formulas added to current and historic price and mathematical equations in order to plot lines and histograms on your chart. The purpose of trading indicators is to help simplify what price is doing. A candlestick chart itself can be very confusing at times. So trading indicators are meant to clean up some of that noise. They can also be used as an invaluable objective rule in a trading strategy or in our trading in general to help us have consistency. So essentially, trading indicators can help to provide clarity on market conditions. They can even help us to identify trend, identify areas of value, help us find entry points, and even help us determine where we want to place our stops and targets. Now, there are thousands of trading indicators out there, and feel free to go test and study all of them to find the ones that fit your trading style best. But in this lesson, what I'm going to do is share with you my top 3 that I use every single day in my trading as indicators to help me make better trading decisions. So let's jump into that right now. The most useful indicator that I have ever found, and with no exaggeration, an indicator that I use every single time I place a trade, is the ATR indicator. ATR stands for average true range, and what this indicator does is gives you the average movement of price out of the last 14 candles. The way it works is it adds up the price movement in total, the total amount of pips each candle moved out of the last 14 candles, and then it divides that number by 14 to give you the total average movement of price in the last 14 candles. Hopefully you can already see why that is so valuable. But if not, let's talk about how we use this indicator. But before we do that, let's talk about how to find it. On TradingView, it's super easy. You go up here to your indicator tab, click indicators, and you type in ATR. It is the first one that is called built-ins. Any trading platform should have an ATR indicator. If it doesn't, you probably shouldn't be trading with it. But the way we use this indicator is to stay in line with the volatility of a market, currency pair, or time frame. For example, there's been so many times that I see a trader or hear from traders and they say, Steven, I don't know what I'm doing wrong. I keep losing trades, and I got a good reward to risk ratio, but I'm losing so much that I'm still losing money in my account. And they'll send me emails of their trades and they're risking 10 pips to make 20 pips, but they're doing that on every currency pair and every time frame. Now, this may work on a 5-minute chart, maybe, right? On a 15-minute chart, possibly. That creates a profit depending on the strategy. But if you're on a daily chart risking 10 pips when the average, if you look up top here, whenever I go away from my drawing tool, the average movement on a daily chart is 190 pips. You think that 10 pip stop loss is going to get hit? Yeah, 90% of the time. 90% of the time you're going to lose that trade because you're not in line with the volatility of the time frame you're on. The same thing goes for different currency pairs. For example, the euro pound in the currency world is a currency pair that has a very small amount of movement per candle. On the daily chart, we're looking at 50 pips. Again, look up here at the circle, right at 48 pips. That's a full day of trading on average for the euro pound. Whereas the pound New Zealand on the same chart, look at this day, 160 pips. So do you think you need to be using the same exact stop loss when these two markets are moving so differently? One moving in tiny amounts per candle, one moving in huge amounts per candle? No, so that's why we need the ATR indicator to help us stay in line with the volatility of a certain currency pair or a certain time frame to keep from getting wicked out by the market. If you've ever been wicked out of a trade, a lot of that could be because you're not following the volatility of a certain market. So now let me move on and show you how I actually use this in my own personal trading. So based on what you've learned so far in this video, what trend is the Aussie Canada in right now? Well, we've had a high, down to a low, up to a lower high, down to a lower low. With that being the case, are we in a downtrend? Yes, we are. And in terms of structure and support and resistance we look for while in a downtrend, what are we looking for? We are looking for the previous level of support to become resistance in a downtrend. And we haven't gone over this yet, but we actually have a nice inverted hammer here, or a nice shooting star candle, whatever you want to call it. I don't really worry about the names of them. This candle has a long wick to the top side. Again, we're going over candlestick patterns actually in the very next lesson. But right now, what I want to show you is how I would use the ATR to help me predict stops and targets in terms of how I would use that indicator to place those. Let's go ahead and put a position tool on the chart. Right now, the ATR, if you look in the top left corner of the screen, right up here, is 67 for the Aussie Canada. If the ATR is 67, what I want to do is make sure that I am at least one ATR above the swing high of this current pullback to give the trade breathing room. So if up to that high is 30 pips, as you can see right here, this is up to the swing high, then I need to add 67 pips to that. That would be a 97 pip stop loss. Now, I know that I said we shouldn't be looking past levels of support like this in order to take targets, but in this situation, let's just do it anyway. And with that being the case, I may say something like, I expect this in terms of targets, right? This was how I use it for stops. I make sure that I'm at least one ATR above the swing high or below the swing low if I'm shorting versus going long. Now, for targets, I may say I'm expecting the market to move 2 times the ATR indicator. So what's 2 times 67? 134. So now I can have a 134 pip target And again, this would work better if there wasn't a level of structure of the way, but for the purpose of the ATR indicator, just go with it. And that sets me up with a 1.4 to 1 reward to risk ratio. This is one of the ways that I would use the ATR in order to place stop losses. Another way you can do this is by this is a more simple way, is by saying, okay, I want a stop loss that is 2 times the ATR indicator from my entry. So that would be 134 from entry, right? And in order to get a 2 to 1 reward to risk ratio, I want to have a 4 times ATR indicator for my target. 134 times 4 is 268, and that would be a 2 to 1 reward to risk ratio. And that would be the